Hello, Stuart Heath here, founder and CEO of Harvard Grace Capital, with a third edition of our investment terms, basic investment terms in our Midweek Masterclass. You can see today we're going to be covering asset class, rate of return, capital gains, yield, and dividends. So again, these are very basic terms that you need to know when you're talking about investing. An asset class is actually just sort of a broad category of the type of investment that you're making. It might be stocks and bonds. Of course, there's multiple classes up under stocks, such as industrials and consumer electronics and things of that nature. In real estate, there are many asset classes, such as multifamily and medical office and retail and so forth and so on. So the asset class refers to the category of the asset for which you are investing, and there are rules for investing in each asset class. The rate of return is kind of what it says. What do you expect to make as your rate of return? And then when you're looking backwards, what did you make? And this is a rate expressed as a percentage. So think of it kind of like an interest rate. If you invested $1 million and at the end of a year you sold it and you made $100,000, your rate of return was 10%. And of course, it can get much more complicated than that, because usually you get paid more than once, and many times you have to wait, or you're going to get multiple payments during the year. So calculating rate of return can be quite complicated. Capital gains. Well, capital gains is very generally a specific term related to income taxes, and capital gain is from the sale of a capital asset, which is generally any kind of an investment asset, an asset not used in a trade or business, but an asset used strictly for investment purposes, such as a stock or a bond or investment in a partnership that owns real estate. And the yield, which is very similar to rate of return, generally refers to a bond issue. So if you're buying bonds, say you buy a $100,000 bond, and it's going to pay you 5%, then your annualized yield is 5%. If you buy that bond at a discount, say you bought the $100,000 bond for $90,000, your yield is going to be much higher. Similarly, if you buy that bond at a premium, your yield will be lower. Finally, in this week's dividends, specifically a dividend is a distribution that you get from your ownership of a corporate stock, but you can also just think of dividends as a distribution of profit that's generated from the operations of a business. So that's it's returning income to you based upon your ownership structure. So would love to hear your thoughts about this. Download our book with all of the definitions and more definitions just for your own reference. And we'd love to hear back from you. Thanks a lot.